Yesterday was a tough day to be a utility. The sector saw its biggest one-day percentage decline since April 2020 as Fed officials reiterated a hawkish tone around future rate hikes. Here with what's ahead for the sector is Yahoo Finance's Inez Ferre. Inez, what are you watching?
Yeah, the utility sector, as you just mentioned, has really taken a beating, and a lot of this has to do with higher interest rates. But let's take a look at our Wi-Fi Interactive so you can see XLU, that's the S&P 500 sector ETF for utilities. Year to date, XLU is down 21%. Compare that to communication services, which is up 35%, technology up 30%. Now, again, higher interest rates, this is the big problem. And this is for two reasons. One of them being that utility stocks are dividend stocks for the most part, so they yield dividends. And when you compare that to bonds, which are seeing higher rates, yesterday, the 10-year Treasury hit its highest yield since 2007 at 4.6%. Well, compare that to the utility sector average dividend yield, which is at 3.4%. So you can see how investors would shift towards bonds simply because they're getting a higher yield on those bonds versus the dividends. Meanwhile, the other reason being that capital is more expensive for these stocks. As the Fed funds rate has gone higher, of course, capital is more expensive. So these utility companies, which have to upgrade their electrical systems, which have to invest in renewable energy stocks, in renewable energies, this is very capital intensive. And so that requires more capital, and that's worse for the bottom line for these companies. The pain has been exacerbated by something that's been going on in the industry. And I'm going to pull up the Wi-Fi Interactive again so you can see some of the utility players year to date. The worst performers, you're seeing AES down here, down 53% year to date. And also NextEra Energy down 38% year to date. Now, NextEra Energy Partners, that's a subsidiary of NextEra Energy, and they recently revised down their annual growth expectations through 2026, citing higher borrowing costs. Again, the cost of capital being more expensive, this makes it more difficult, more challenging to fund projects.
Indeed. Appreciate that update. Thank you so much. Our very own Inez Ferre.